I'm in Nigeria. I'm in Abuja, Nigeria. So I'm a civil engineer, real estate developer. Recently, what I do is we teach people how to invest in the stock market. When you talk about developed economies, we teach people how to invest in the stock market so that they can, the stock market is like the greatest wealth creation machine ever. So, but a lot of people in Nigeria are not yet used to it. So a lot of people in Nigeria are not yet investing. Sometimes you see them putting their money in the wrong investments, like Ponzi schemes and all that. So what we do with the wealth hackers is we try to bring awareness to people. We teach them on what they are supposed to put their money into, how to navigate the stock market. Recently, we're even talking about the crypto market as well. So for the sake of the people who have joined us and everybody who will listen to us, can you just introduce yourself to us?
Yeah, so my name is Anirban Mahanti. I'm an advisor, a lead advisor at 7investing. Before that, I was director of research at Motley Australia. I've managed portfolios. I ran a microcap, Australian microcap focus, Australian listed microcap type of stock investment ideas. Before that, for many, many years, I'm actually a computer scientist by training. So I worked at various research labs, worked at various universities. I've worked in Canada, India, and Australia as a researcher before I basically became a full-time investor. So I became a full-time investor only in 2015. But as I said, I'm a computer scientist by training. I have a Bachelor of Engineering in Computer Science, I have a Master's and a PhD in Computer Science. I did my PhD way back in early 2000s on video streaming systems. So I developed video streaming protocols. And then in my research, I worked on content distribution. So how do you make content, how do you deliver content efficiently on the internet? I did a lot of network measurement work, which basically looked at measuring things on the internet and understanding their properties. So whether it's YouTube, so we wrote one of the first YouTube traffic papers that were published, it was published in 2007. I've done a lot of work on sort of web hierarchies and caching and things like that. Later on with my students, I did a bunch of work on applying sort of artificial intelligence and machine learning technologies to sort of computer systems type of problems. One of them, for example, that we got quite a bit of attention was for essentially classifying traffic as traffic is going through a network. So at a gateway, which could be a enterprise gateway, or could be even a telco gateway, looking at traffic without actually reading the content of the packets that are flowing through the network, just looking at signatures of the traffic and trying to figure out what type of traffic it is. And this was for those days when there was a lot of BitTorrent traffic on the internet, and people might have been interested in shaping the BitTorrent traffic. So yes, so a lot of I worked on AI and AI tech before AI tech became sort of the main thing that people talk about in media. Now every company is an AI company, right? But I was working on this in around mid 2000s.
Yeah. All right. So I learned earlier that you were in Nigeria sometime. We want to know about that. When were you in Nigeria, and how was the experience from Nigeria?
Yes. So, so I come from a family of academics. My father was an academic. He was teaching at University of Ilorin, I believe, at that time. Mathematics. He was in the mathematics department. So yeah, we lived in Nigeria from 1980 to 84. So I was very little, but well, my experience in Nigeria, we lived in a campus. So in a university campus, and it was fantastic. They were world-class campus, like beautiful houses. We even had a car. We had a Volkswagen Beetle in Nigeria, green-colored Volkswagen Beetle. So, and then when we went back to India, it took us a while to actually get a car. So, we had a better lifestyle in many ways in Nigeria. I used to love having Coke. I think the Coke, in a bottle of Coke was 4 kobos or something like that at that time. It was very beautiful living in Nigeria at that time. And we sort of left Nigeria, I think, in 1984. I've been to Lagos, I've been to Ilorin, we've flown via Kenya. So I have a bit of an idea about Nigeria and Africa. We had some friends who were from, places like Botswana and Zimbabwe and things like that. So a bit of an idea, but that was many, many, many years ago. And then when I went to Canada to study, I had many peers who had come from Nigeria as well.
Yeah. Okay. I'm hoping that we'll get here someday very soon. Although a lot of things have changed, but I'm hoping you can come back someday. Maybe we'll actually get to see you face to face and all that. So let's just get right into it. Can we understand a little bit? We understand your educational background, something about your childhood, but how did you actually get into investing? How did you even start investing in the stock market and knowing about all this?
Yeah, so I was interested in, so as I said, I'm an academic by training. And so we focused a lot on academics and making a career. So I didn't really invest until I got my first job as a professor, as an assistant professor at the University of Calgary. That was really like early 2004. And I started, so now I have a job. I should kind of maybe have some savings and maybe I should invest some. And I invested mostly in like mutual funds, really, like, basically go to your bank and just invest in something. And that really didn't do much for me. And I left Calgary which is in Canada, in 2007 to come back to India. So I withdrew whatever I had and made some money, but not a lot. Came to India. So basically I missed almost entire GFC because the GFC happened and I didn't really know about it because I was not invested in the market as such. Yeah. And in India, we had investments, but this, we have what is called listed investment company style investments. They give you fixed returns. It seems like good returns, like, you're getting 7%, 8% returns. But what I think one needs to realize, and I didn't realize at that time, is if inflation is very high, if inflation is like 8% and you're getting 6% returns, then you're actually going backwards, right? It seems like you're making money, but you're actually not. Yeah. And then, in 2009, we came to Australia. At that time, I sort of started getting more interested in investing. So really, in 2009 is when I started and make all the rookie mistakes that one would do, in terms of investing. It took me a little while to sort of figure out my investing style or approach that I should use. And I have a friend here who's Dutch, and he has been investing for a long time, right? And since he was 18, because Dutch people invest very early on, which is really great. And he, when they said to me, like, you should be not investing in mining companies, or you should not be investing in oil and gas companies. And I asked why? Because those are the type of companies that are majority listed on the ASX, Australian stock market, is largely mining, explorer, mining, banks, financial companies that are listed here. And I asked him why? And he said, well, for a simple reason, you're a tech person, you understand tech, you should be investing in tech. And I said, okay, that makes sense. And that made me think, okay, I should look at things like Netflix. And I said, oh, okay, yeah, that's a good idea. Let's invest in Netflix. So sort of my investing style changed because I had a good friend who sort of pointed me in a direction and gave me something that I could associate with, something that I understood well, something that I could, figure out, okay, this makes sense. And that's sort of how my investing happened. But investing is mostly to sort of, invest savings that you make so that you can plan for retirement at some point.
Yeah. Yeah. Okay, so let me just get right this angle. How much did your academic work and sort of your background shape your investment strategy? There are a lot of people who tell you due to the way they grew up or due to what they learned from their dad. How much did your background moving from these countries? Because from what I think, you've actually lived in a lot of places, from Nigeria to Canada to Australia. So did all these things shape your investment strategy?
That's a brilliant question, Daniels. I think exposure to the world is hugely important. I think that really helps. So I said that, I look at developing world in a different way because I come from a developing country and I've lived in other developing countries, and I sort of see the potential and the difficulties, right? And that is a huge edge if you can cultivate it in the right way. And to give an example, so payments, right? Payments is relatively easy if you live in America or in Australia or in Europe, right? But payments is a huge challenge if you live in India or Nigeria or Brazil, right? And payments mean completely different things in these countries, right? So that's an example. I think those can be huge edges that people can cultivate just by your understanding of how the world sort of works, right? And I think exposure to different things is hugely positive. Then I guess the other thing, so understanding a little bit of maths helps. And I don't mean like, you don't need PhD level maths. You just need a little bit of maths understanding, right? So you need to understand in the stock market that, you have a certain probability of being right? And it's not 100%, right? So that's if you just think probabilistically, it really helps. Then you need to sort of realize that, well, if you're right 60% of the time, for example, that might be enough. Why? Because your upside is not capped in some sense, but your downside is capped. And other simple things like, if you make multiple decisions, then you handicap yourself, because if you have a probability of being right, that's 60%. If you make two decisions, now the probability that both decisions are right actually goes down, right? So it's 0.6 times 0.6 is 0.36. So the more decisions you're trying to make simultaneously and concurrently, sell something, buy something as a replacement idea, you reduce your odds of being successful. So I think that helps. And I think my background training sort of, in tech has been hugely useful to invest. I mostly invest in technology stocks. So, software and, AI and, self-driving, those sort of places is where I like to invest. And then understanding the technology, even at a higher level, and sort of appreciating some finer points that, why is training in machine learning very important, and why does training make a big difference, and why is labeling data very difficult, and why better processes for labeling data can actually give you a huge edge. Those sort of things can be very useful. So that gets into a little bit more technicalities, or as I said, like, try to separate the wheat from the chaff, right? It helps you understand why a certain company might have a competitive advantage. But in general, I say that people can learn most of the things. You don't need a PhD in computer science or a PhD in mathematics to actually invest. You need basic mathematics skills and basic logic skills to invest. And then the rest of the stuff you can just, read annual reports. So if you read a 10K, which is the annual report released by US companies, get it from the SEC's website, pick up PayPal and reads its annual report, or Visa or MasterCard and its annual report, and you learn so much about payments. Right. And if you read then the same of Aiden, then you learn so much about payments and how things are in Europe, for example. Right. So I think those are sort of the things that help people, is my view.
Okay. You've actually said a lot, and I have a lot of things to ask. But let me just go from, because it's not always that we get a lot of people that actually understand the developing countries. Most of the people talk to that are into the US stock market, they are like, you people have internet in Africa. So they don't understand us so well. They don't understand India. They don't understand Nigeria. So you that understand this, do you actually invest in the Indian stock market? We have an ongoing. A lot of people are saying, forget the Nigerian stock market, forget any developing country, focus on the developed economies. So what's your take on that? Do you invest in developing economies, or do you do a mix of both?
That's a great question. So, Daniel, I actually specifically don't invest in any market. So my thesis for investing at a very high level is simple. What I say is I want to invest in the best ideas, right? And the best ideas are just the best ideas. They're not necessarily any market focus. So I really dislike the idea of focusing on particular markets, because that, I think, causes, I guess, it causes sort of a silo approach. Like, I know, for example, most Australians invest only in the Australian stock market, but the Australian stock market is 1.8% of the global stock market. So in other words, you're fishing in a really tiny pond. Why would you do that? It doesn't make sense. So same thing. So now, to answer your question, here's how I look at it. I sort of think of developing markets as an opportunity. Then I try to think of which companies can make the best advantage of that opportunity, right? The other thing I try to keep in mind is the best companies of Nigeria, India, Peru, Uruguay, Brazil are actually when either are private, so you can't access them, or when they go public, they list on NASDAQ or a New York Stock Exchange.
Yeah.
right? So that is the
Yes,
other
yes, I
reality
know that.
is there. So in other words, if you focus on the local market, you might land up with picking, no, on average, maybe tier two, not all of them. So like Reliance Industries, for example, is the biggest company in India. That's a great company if you want to invest in a conglomerate, right? So I don't try to do that. Sometimes people might think about investing in ETFs. Again, I don't really do that either, because what ETFs tend to do is create a basket, and the basket tends to then lower the average return. You could still get a market beating return, but lowers the average return. And yeah, so my I do look for companies that are global, that are emerging market focused, but that are listed overseas, for example. So, like, there are companies in Mercado Libre. Mercado Libre, for example, is a great example. So MELI, MELI is the
Yeah.
stock code, right? It's again Latin America focused company, but is listed in Nasdaq, right? There's another company from Brazil called StoneCo. STNE is I think STNE is the code. Again, a Brazilian company listed in Nasdaq. So I think you'd find a lot of these companies that are listed overseas that are actually interesting, have high growth rate, are focused on particular industries. So that's what I do. I do have a portion of my investments in international stocks. They just happen to be listed mostly in the US.
Okay, yeah, I think that's fantastic. We have a company here. I know you're familiar with it. It's called Junior. It actually went out skyrocketed some time ago. So their primary operations are in Nigeria. So that's just a typical example of what you give. A company that when they wanted to list, they had to actually go to the New York Stock Exchange or Nasdaq. Something you mentioned about ETFs. So let me just ask a little thing about that. Now, we have a lot of people who say the Redelio school, the people who believe that you're supposed to be extremely diversified at all times to actually beat the market. Then we have a little of people that who actually are schools of Warren Buffett, who believe that just need 6 or 7 stocks, that your seventh idea be the mistake that will ruin your collection. So, what's your take on diversification versus having a bit of concentrated portfolio? Do you think, and then can you just enlighten us as a retail investor? How many stocks do you think is like someone have and the person is not going to be over diversified? Thank you.
Right. So my answer for that is the answer is really, it depends. It depends on you, is what I say. What is right for me might not be right for somebody else, right? So, I mean, that's number one. I think the most important thing I've found in investing is to sort of understand yourself. If you understand yourself, then you can manage the challenges that come with the stock market's volatility. For example, when a stock falls 30-40%, you can actually manage through that if you understand what you're doing. So I think that's very important. I don't have a specific, I think my rule of thumb is that if you have too many stocks, then you are going to tend towards the market. But here's another way, and again, depends on what you call the market, right? But let's say the S&P 500 is your market. Then S&P 500 is 500 stocks. If you have 50, you have only 10% of that. So is 50 too much? Maybe not, right? So some people would say you only want 30, you only want some number of companies that you want to follow very closely. Again, it depends really on what you're doing. If you have a small number of stocks, you're going to be heavily concentrated. So my strategy has been, if I find a good idea, I take a position. And I don't really think of how many positions I have. And then if I have money, I will look at my portfolio and say, well, okay, which companies do I like right now to add more money to? And I will add among that with one condition. I will not add to a company which is already a big position. And for me, a big position would, I'd say once it's about 4 or 5%, I don't add to it specifically, but I let it run. So my largest position, or our largest position across all our holdings, is Tesla. It's probably around 28% of the entire portfolio. It sounds really ridiculous to have 28% in one company, but I didn't put 28% cash into it. That's because I've held it since 2013. It has just grown, and I let positions run. So I let positions run as long as I believe in the company. I'm not scared away by a large allocation, because and again, this is very personal. I'm not scared away by, because I'm happy. I'm okay if the stock gets cut in 50%. because that would be a big hit for the portfolio. If a 30% position or 25% position gets cut by 50%, you're going to take a big hit on the portfolio. It's going to look really ugly, right? But you have to accept that, because if on the other side you're thinking that a company can go 10x or 5x or whatever, then the path to 10x, 20x, 30x is through 2x, 3x, 4x, and so on, right? And therefore, letting things ride is important. Yeah. So what I do is I commit capital to a specific amount, and then I stop. But then I let companies do their thing. And I tend not to sell frequently. So I only sell if I think the thesis is completely broken. And I'm really patient. By the time I realize something is broken, the stock is probably down 50, 60, 70, 80% from where it was. So it's a risky strategy that I follow, but it works well if you invest with an upside mentality. So I invest when I put a position, start a position, my thinking point is it 6x to 10x from now, right? And that's the point.
Come into a particular run. So I want to understand, is your strategy lump sum investment? Like, do you normally like buying everything at once? Or because a lot of people have said that the best strategy to go for the market is a dollar cost averaging, where you buy by bits so that you can mitigate the risk over the long time with the ups and downs. So do you normally do lump sum investments, or are you somebody that uses dollar cost averaging as well?
Yeah, so as I said, so basically my strategy is sort of like dollar cost averaging. I don't specifically do dollar cost averaging. I'm not, but it happens because, well, everybody has savings coming in, or at least people who are working, their savings are happening at set periods, right? You get your paycheck and you have maybe some savings from it. Put together some money and you've got some amount that you can put away. So sort of that's my strategy. I just invest over time. And as I said, I'm just investing over time. And when I'm ready to invest, which is typically, every so often I'm investing, I'm looking at the portfolio and I'm looking at ideas I like. I think, okay, maybe these are the 5 ideas I really like at this point. Which one do I put my money into? Then I look at the allocations. I'll typically put in the ones that I like the most, which are the smallest positions. And that's really it. There's no, like there's a lot of, there's a lot of things you could say about being very specific and, having algorithms and calculating. I don't do any of that because I just think that's a waste of time. It's just a waste of time. I just keep it simple. Find ideas that I like, have money to invest, put in the positions that look the smallest, and there we go. And then you let the companies do their thing and you move on. It's a simple approach. It works for me. But, again, it might not work for anyone. And again, I'll say this. It's easier to do what I do for my own personal portfolio, because you can't manage, say, a public-facing portfolio. You wouldn't run a portfolio where you're reporting every month to your clients that, hey, I've got a 30% position and I've got a 10% position, I've got a 15% position. People will freak out. You just can't do that. Yeah. Right? A retail investor could if they wanted to, because it's their own money, right? And you're not really responsible to anybody else but your own self. So I think it really depends on what you and your family are happy to accept as risks and as a strategy. And as long as you can keep your family members whose money you're investing, I guess, happy, you can do whatever strategy works for you. And that's an edge. It can be an edge.
Yeah. Okay, I think that's a very interesting thing you said there. I want to understand, with the way you invest, how do you normally handle downturns? We know we had a very nasty one last year. The coronavirus hit the market, and then we had that sharp decline. So how do you normally invest during downturns? An example, we have a Cathy Woods that says, okay, what she does during downturns is she takes money from her lower convictions and then pushes it into her higher convictions during downturns. Do you have a particular strategy that you use during downturns?
Yeah, so I think Cathy Wood's strategy works. If you need, so here's my strategy: is I always have some cash. I always have some cash. Sorry, my wife's taking something from the room. So I always like to have some cash for exactly that reason. And it's not, so here's the thing about cash. The theory would be that you should always be mostly invested because market rises over time. So therefore, it makes sense to be mostly invested. but that ignores emotional component, right? I feel really good if the market is down 30% and I can invest. I would feel really crappy if market is down 30% and I have no money to invest, right?
Yeah.
So, so to control my own emotions, what I do is make sure that I have some money on the side available to take care, which means I'm happy to take no returns on that cash. And that's my strategy. My strategy is to have some cash. And then if I still feel that, okay, I need to raise more cash, then I would probably do what Kathy Wood is saying, which is sell my lower conviction ideas and cycle them into my higher conviction ideas. That's one strategy,
so
but I think that having cash is useful.
Do you have any particular percentage of your portfolio that you keep as cash, or is it at random?
No, so again, that is a very specific question that goes into your individual style. So, like, we are lucky as a family to have plenty of cash flow, and we, like my wife, for example, runs a business. We have a business on the side, and we keep some cash in the business. We can draw some money from the business. The business could pay us a dividend. So we are not as fully invested, but probably I would say that we'd have about 20% of our, but 15% of our total investment amount available as cash, right? But that's because we have other responsibilities, like we have businesses that we are running. So if you're running the business, then you need to have some cash. But our worst case opportunity is we can tap cash sources. Not everybody is in that position, but I feel like 10% cash seems reasonable. But I don't have that cash sitting in my brokerage account, right? The cash is probably sitting somewhere else. The other thing I'll point out is, like, many people who are homeowners, like us, for example, you could actually tap into your home's equity, right? So that's another thing that is an option available to homeowners, is that you could tap into your home's equity, and home equity is available at a very low interest rate, right? So that's another option that exists. So I think, again, over time, what happens is, as you invest and as sort of you move up the ladder, then you have a few different levers that you can pull. But I feel like 10% is a reasonable amount. Seems high, but 10% seems like a reasonable amount to have, which gives you a bit of flexibility in a downturn, right? Keeping in mind the downturns happen, right? I mean, you have a pullback once every 18 months of maybe 10%. Once every 4 or 5 years, you have a pullback of like 20, 25%. Sometimes you have a 30% pullback, right? Like the coronavirus pullback. And think about it. If you put some money to work at that time, you'd feel really good about it, right? So, yeah.
All right. Wow, that's okay. I think a lot of people in the group used to kind of get surprised when I used to preach to everybody, keep some cash, because most of the people there want to actually just stay invested, put everything in the market all at once. Having said that, let me just drive it to this angle. We had a lot of debate. Trading versus investing. I know you're an investor. Do you trade at times? And then we have to say about people that trade. I've met a lot of investors that actually forbid trading. They tell you it's a waste of time, that you should concentrate on investing. And I've actually talked with a lot of people who believe that you can trade and then invest as well, and you can actually use your short-term gains on trading, solve some daily problems, and then put the remaining to the investment stock. What is your strategy or opinion when it comes to trading versus investing?
That's a great question, actually. So I don't have any problem with people who want to trade. I don't day trade at all. That, because I find that is not useful. But I'll give you an example. So my majority, or 95% of my portfolio, maybe 99% of my money is invested long term, right?
Okay.
That doesn't stop me though from, like, if I see a short-term opportunity, like when I say short-term, I'm really thinking couple of years or a year or maybe 2 years, and there are specific catalysts I'm thinking about. I do think that can be useful. Okay, it can be a passion. So I use options, which are basically derivatives. I use puts and calls, and I use them as a complement to my portfolio.
Okay.
Somebody muted me. Now I'm unmuted. Okay.
Yeah, sorry about that.
Yeah, no worries. So I don't have any problems with trading. in the sense like, I mean, you can sometimes make opportunistic money. So what I do is I do have some positions that I maintain, which are options based, which are specifically focused on just income. They're not very short term. They tend to be between 6 months to 2 years, sometimes 2.5 years. And these are call options that I might buy on a company because I think it's undervalued and there's likely some catalyst on the horizon. I might write some puts, which might give me an entry point into a company at a lower price. I think it's fine. Is it a big deal for like overall? Would I miss it if I didn't do it? No. But yeah, and sometimes another thing I'll point out, sometimes you'll find a mediocre company available at a really cheap price.
Yeah.
If you think that the company can survive and is not going to die, and that there's going to be a re-rating or the company is going to get revalued properly, you could buy it. In fact, if you own mediocre companies, I would say that your thesis should be to sell when the price seems overvalued, and to buy those mediocre companies when the price is undervalued. Whereas for great companies, I think most of the time there is no price that is overvalued, because typically the market never fully values a great company. So innovation is always undervalued. But if you're buying into some mediocre coffee chain, or like some mediocre fast goods FMCG company, yeah, you should absolutely sell at the right time, and you could buy at the right time.
All right. Okay. That's actually a great question. Now, before we move into some other things I have here, I just want to understand how your the time you've spent with Motley Fool and 7investing, how it has actually shaped you as a retail investor on your own. And then what are the additional benefits of working with a big organization? Some people can learn a thing or two from there.
Yeah, so the Motley, I'm a huge Motley Fool fan. That's why I joined the Motley Fool. And then, like 7investing was started by Simon, who used to be at Motley Fool, and I worked very closely with him. And, he basically had some really interesting things to offer to me. So I said, okay, why not? Why not, do this, because I was mostly focused on the Australian market here when I was at the Motley Fool, but my interests really are in tech, which is in the US. And Simon had a very interesting model and a team that he had built. So that's why I moved to 7investing, a team of specialists focused on certain areas. I'm I'm a huge David Gardner fan. So, David Gardner is probably the godfather of growth investing in many ways. So people don't know him, maybe as many people know him, but people know Cathie Wood. But before Cathie Wood, there was David Gardner, and David Gardner really invented, in many ways, the idea of how growth investing really works. So I'm a huge David Gardner fan, and I sort of had the opportunity of meeting him many times, and learning from him, and just observing him. So I think I joined. I tried to make this transition because I was a David Gardner fan. And a fan of what the Motley Fool did, and it was a difficult transition to make because nobody would want to give you a job if you don't have the background in sort of finance or in stock picking. But I was involved with some Motley Fool boards, so I used to cover some stocks on the Motley Fool boards. And I applied. I think I applied twice. Once I was rejected. The next time I actually got the job, and I got the job largely because I think I had the tech background, which could have been useful. But working with my colleagues at the Motley Fool really helped me. It again, sort of gave me this other side perspective. And when you marry the two perspectives, when you can make interesting decisions. So it has definitely helped me grow as an investor. And a couple of things with investing, right? You grow over time. You grow with your experiences. You grow as you read. And you grow as you sort of learn from what is happening around you, right? So, and that's really been my journey, is that just growing with people, growing with time, growing by reading, and just growing by application. Really, you got to make some mistakes to learn, okay, that doesn't really work. And why does that not work? And people would say that you're making inferences based on individual actions, but that's what we do all the time. You need to just think about them and think carefully about them to make sense of them, and then that becomes a way to learn. But I found reading people and observing other mistakes people make, right? So everybody has got blind blind spots. You need to be able to also realize what your own blind spots are, but also be able to realize, oh, that person's blind spot is that. And that doesn't make that person a bad investor or anything, right?
Yeah.
So I know investors, I know without taking any names, I know investors who would, for example, know that this is a great company, but would not invest in it because it's a tech company and they think that they have no edge on tech. And my answer to them is, maybe you have no edge on tech, but do you really have an edge on retail? As an example, right? Because you think you have an edge on retail, but you really have an edge on retail is something to realize. And maybe they do have an edge on retail and they invest in retail, but it's I think that your ability to expand your horizon really is up to you, right? And I think this is one of the most misquoted, I think, Buffett's things about circle of competence. People think that they have a circle of competence in something, but people don't allow for the fact that your circle of competence is anyways limited. What you really need to realize is that you can make mistakes, and mistakes are okay because of a fundamental reason that your mistake is always capped at 100%. The maximum you can lose is the amount you put into a company, right? And if you realize that, then you can think about your investing in a slightly different way. Like, okay, the mistakes are going to happen, and it's okay to make a mistake in different areas, right? So I say you have to bat often to get your averages right? Just like playing cricket to some extent. You want to have enough number of goes at the bat, right? And so that you come out with an average.
Yeah. Okay. All right. I want to ask you something. Something you just mentioned. You said you can only lose 100. But we know clearly that two things that can make you lose more than 100 is when you are using leverage, or maybe you start averaging down once your portfolio starts going down. Now, what do you think about those who trade or invest with leverage? And then what do you think about those who actually always average down? A lot of people actually preach averaging down. Like if you own a stock, once going down 30%, that you start buying more and buying more. So what do you think about those two conditions that can make you lose more than 100%?
Yes, so that's a great question. So leverage is really bad for people who don't understand what leverage is, right? So leverage on the upside is great. Leverage on the downside is equally bad, right? So I said I use options. Options are a way to leverage your account. And if you use them incorrectly, you'll get into a lot of trouble. So I tell people that if you don't understand how you're using leverage, you should not have them. That's, again, it's up to individuals, but I think leverage, you need to understand that leverage has this upside downside that makes things skewed. In general, I say that people, unless they're very experienced, should not use leverage. That's my personal opinion about leverage. The averaging down is a very interesting thing. So averaging down on average, in my opinion, is bad. And that's because typically, so here's a thesis, right? Typically, the market is really good at figuring out if stuff is going wrong. It's also good at figuring out if stuff is going right. It may actually, in the short term, it's not really good at, I think, figuring out how much it should be priced at and how low should it. So how high or how low. It is not good at long-term pricing, but it's really directionally actually good. So if a bunch of people are selling a company, it basically means that it has bad results. On average, it typically means it has bad results. And therefore, if you're buying it, you're doing the sucker trade. It sounds counterintuitive, but I mean, the crowds, I think the wisdom of the crowd is right. What it is not right about, I think, is the price over the long term. So when it's selling it, probably it should have sold it really hard, but it didn't sell it that hard. And when it's giving it a boost because the earnings are great, it didn't account for how the earnings can do over the long term. So it doesn't give it that much of a rise, right? I'll caveat that by saying, of course, sometimes it goes, of course, there'll be times when it will shoot to the upside and then there'll be times when it shoot to the downside. So in general, I don't do average down. However, I'll caveat that. When you really understand something very well, then there can be exceptions to the rule where you can actually average down. And those average downs can be really good trades if you understand what you're doing. I'll use Tesla as an example. So I said I've owned that company since 2013. Then I had SolarCity shares. Those got converted into Tesla shares as well. Then in 2018, 2019, there was a huge amount of short attack going on at Tesla. right? At that point, if you understood what was going on, and if you understood the mechanisms, I spent a huge amount of time trying to understand what is going on, what's happening in the options market, how are people shorting the stock, and how is the options market and the market makers impacting the stock? How can a company like this have a huge float? It had like a 25% of its float was shorted at one point. That's huge for a large company. So I bought more. That was a trade of a lifetime, because that 2018 position is up 10x, right?
Wow.
So you can only on occasions make those deals, but you really need to know what's going on. You really need to understand what's going on, and you really need to spend the time to understand it. But if the theory is, if it's down, I'm going to buy because I bought before, that's bad. It's down and you're buying because other people do not understand it, or other people are manipulating the stock, for example, or we're trying to manipulate the stock, then that's an opportunity, right? So Tesla has, for example, has been a stock that's been a stock which people fight over, right? But if you understood why people are fighting over it, and that there are these very paralyzing opinions about Tesla, is it a car company? Is it a tech company? What are they doing? Do they have a lead in self-driving? Do they not have a lead in self-driving, right? I mean, you really need to understand a lot of things to actually answer those questions, because, and you would assume that a lot of these people who are shorting it are shorting because they have, and you'd hear that people are short, or they have, they shorted Enron or something else, or, they were great in the GFC. Well, that was one instance of being right, one famous instance. That does not make them geniuses. Right? So the thing is that, again, you can't believe everything that you see. You have to make your own assessments, and maybe they're right? They could still be right. You have to make your own opinion. So all my point is that you should average down only if you have high conviction, and the conviction is not based on price. The conviction is based on research and understanding and your own independent, we call it variant perception. You should have a perception that's different from the market. That's where you can make big bucks. You make big bucks by having a perception that is very different from the market, and you're willing to wait for the market to come to you.
Yeah.
Right. You have to be patient. So this is like, it happened, from 2018, it took until 2020, 2 years for the, but Tesla stock, for example, was relatively stuck in a no-go zone from 2016. Right. So for a long time, the stock actually didn't do nothing. And that's okay. You have to accept that sometimes that's also going to happen. And now the Tesla stock is sort of set at a new level, and it's kind of stuck there. And a lot of people will bail probably, and that's okay, right? Again, it depends on what you're thinking about, right? You really have to have a thesis.
Yeah. Okay. Yeah, I think that's a very fine one. Let me just ask you something, because something you mentioned quite earlier was about AI. How you were one of the people that were in the AI industry before everything is AI. Now, I think AI is just almost like the new .com. Every company is using AI to what they do. You meet companies into fast food, they say they are AI, fintech, AI. So, what distinctions do you make for companies who are really into AI? There's a ticker, a dollar sign, ATER. A lot of people were talking about how it's AI and all that. I think it went up to $90. Currently, I think it's trading at $2. That's just an example of what people do, because whenever everybody had AI, so a lot of people rushed into it and the price went up and it now later crashed down. So what distinctions can retail investors make, or do you as an expert know that, okay, these guys are not even really into AI, they are just trying to drive the traffic by mentioning AI?
So, there's no algorithm as such. You have to read and see how they're applying. You have to see the information that the company is providing to assess, okay, does this make sense? Right? And some of that is just experience. And you'll get things wrong. I get things wrong a lot. I would pass on things. So one of the things I figure is that if I look at it and I don't understand their edge, I just let it go. And that's okay. Sometimes I'll be wrong, but I try to make sure that the things I am going for, I understand what the advantage. There's a simple thing to think about. Sometimes data is an advantage, right? I have said sometimes because not everybody has data, right? But the question is, is the data special, and is the data giving you some sort of data effects, data network effects? In AI, having a lot of data and a special type of data that you can then label and then train is an advantage, because your models become better. And sometimes what happens is, if your models become too much better than everybody else's models, then the other people don't actually have a starting point. So it is, in my opinion, a winners takes most market, because once you have gotten ahead, for the other people to catch up to you, they basically have to repeat the process that you have. But why would consumers or other businesses use an inferior product so that your product can actually become better, right? So it's this chicken and egg problem. Like if you are applying, if you are applying AI, you're applying AI to a problem. Currently, your solution probably just has to be a little bit better than the state of the art, right? And then you get some customers. But then over time, it becomes so much better. How does a competitor then catch up to you? It's very difficult, right? They have to catch up to you with a completely different business model. So I think that's the way I think about it. But I try to also look at industries they're trying to disrupt, right? So data disrupts industries. And if the industry is large, then I think it's an interesting place to be, right? So like my typical focus is on large disruptive industries. So AI, for example, for cybersecurity is very interesting, because cybersecurity is a big industry. AI for self-driving, for example, is very interesting, because it's, again, it completely changes the game. AI in finance and fintech, for example, is very interesting, because fintech, finance as a financial service, if you think about it as a whole, and banking and lending, they're the oldest industries in the world, and also one of the largest, right? So there's a lot of opportunity there. And it doesn't mean that one company, because there will be many slices of different ways of applying AI, right? So I sort of try to think about the big problems that exist and how data can alleviate those problems. That's the focus. And if they can do something there, then that's where I think it's useful.
Okay, I just want to ask a little bit about China, because China is like one of the most technically advanced countries in the world. But we know a lot of things have been happening. Chinese stock have been facing this critical crash and all that. Now, when it comes to tech, we know that these guys have the tech. Are you still invested in Chinese stock? Do you see them as undervalued and something that some retail investors should be looking at the moment? Or do you think, like a lot of people are warning and running away from them, that everybody should just avoid anything China because of the political kind of cloud around the whole stock market in China?
That's a great question. And, this is something that we talked about today on the 7 Investing Spaces. And so I had to push our meeting back by an hour. So apologies for having to do that in the last minute. So China, I am not specifically invested in any Chinese stock right now. That's my personal situation. But the thing that's going on right now is there's a general impression that what is happening is largely a backlash against Chinese tech companies listing overseas. I don't think it is exactly that. So I think it's regulation. So there's some interesting things there, right? So for example, a company like Alibaba has these conditions that it imposes on merchants, saying that, if you are selling on Alibaba's marketplace, you can't sell on any other marketplace. Well, that sounds kind of anti-competitive, right? So you're preventing a merchant from actually having other opportunities. Why? Right? So if the government is cracking down on it, it seems like they're basically opening up the market. So they're basically deregulating the market via regulations in some ways, right? Yeah. Then there was some instance about two music streaming companies that are, basically going to merge. Well, that would create like someone who would own 80% of digital rights to streaming of Chinese media content or Chinese music content. Well, that's a monopoly, right? They can charge whatever they want then at that point, or they could have whatever model because they own the market at that point. So I think my view is contrary to what people might think. A lot of this is about maturing the marketplace. Yeah. Right. If that's my view. So I'm actually not saying that, it's specifically targeted to companies that are, these companies are huge, they're big. A lot of investors are interested in them. Because the investors are interested, they have decided that they're going to list some of these shares, or part of these shares, in global markets. I don't think it's that. I think it is more about the fact that technology has a direct impact on consumers, right? And the government therefore is saying that, well, it's a way to influence, right? So there's a lot of underlying things that you could say that tech leaders can become influencers, and that can have an impact on how the government runs different things and so on and so forth. But Those are the underlying facts, maybe, but there is a regulation impact as well.
Yeah.
And it's in many ways making the market more accessible. So I think my take is one has to be a bit careful, right? So Alibaba, if you value it, say, based on free cash flow, will appear to be very cheap, given the growth.
Yeah.
But the question is, it had some practices on that was applying that may no longer be applicable, and therefore, is the current free cash flow level of growth that you're seeing indicative of what it can have in the future? That's number one, right? We don't know. Number two is, if the market becomes more open because the government regulations are making it open, well, maybe new incumbents with new technology and new things will come around, right? So there'll be more Chinese tech companies that come and they will squeeze out some of the old guard. Maybe, right? So I think, in my view, it's right now, I don't have a specific view as to which way to bet and things like that. It's very hard in my view. That's my personal view. And it's in my too hard basket, and therefore I just basically say pass. I'm saying I'm not invested because I believe that I don't believe that the Chinese government is out to, out to destroy these companies because they're listed overseas. Actually, that's not my thesis. My thesis is that I think the market there is now changing because they have a huge middle class, and they have a huge tech force, and they have a lot of technically, well-trained individuals who can actually make that market into an even bigger market, but they're trying to maybe open up that market to create a juggernaut type of market, a market that, so if you think of equity markets, Chinese equity markets about 20% of the global equity markets, the US equity markets about 55% of global equity markets. If you want to take the 20%, in relative terms, you want to grow it and make them similar in size to the US. That'll be ultimate in power play, right? And then you want to make the market more free, and you want the best people to win, and you want to create the environment. Maybe this is that. So maybe this is some long-term thinking. I don't know. To me, it looks like it's too hard. So I'm basically saying, well, I'm just going to watch it. I watch it because I think it's something very interesting things are happening.
Yeah. Okay, all right. Let me just drive you straight to the new kid in the block. Not relatively new, but the attention is in getting is has been a lot. Now we've seen a lot of fintech companies actually embracing cryptocurrencies. So I just want to ask you, what's your take on cryptocurrencies, and where do you see the whole fintech and fintech crypto integration going in the next future? Are you bullish? Are you bearish? What's your take on cryptocurrencies as a whole?
So this will disappoint you because this is going to be like my China answer. I like the crypto tech. I just don't know where it is going, and the reason I don't know. So I think the tech is wonderful, right? So you can have a cryptocurrency, digital currency can basically enable seamless money transactions across the globe. Question then is monetary transactions. Question then is, then how does regulation work? Right. The other big question to think about, at least in my mind, is one of the reasons we have fiat currencies and government-controlled currencies is that, well, how do you do stimulus if you don't control the currency? Well, you print money, right? But you can't print crypto. And I know that is one of the arguments for having crypto. But if you can't print money, you can't control the economy. You can't control the economy. You can't control what's going on in recession. You will have social dysfunction to some extent. So while crypto solves the problem of money devaluation, it doesn't solve the problem, right? Maybe money devaluation is actually not a problem, is my point, right? It's if the financial system is properly managed, then devaluation is basically maybe meaningless. I don't know, right? It's only hyperinflation that matters, right? And hyperinflation really is a very specific problem to certain economies, right? It's not a problem for other economies. So while you might think that there's a lot of quantitative easing happening, everybody's doing quantitative easing. In a way, it's all kind of washes out. Everybody's borrowing from the future. Well, everybody's indebted to, the future, right? So put another way, I am not really sure. I think in concept, the idea of cryptocurrency is great in concept, but some of the problems they're solving seem to be not problems. Having a fixed number of coins is a problem. It might actually be a hindrance, right? So I think I give them a tick for the ability to ensure seamless transfer of seamless exchange of coins. They are great because they challenge the current payment rails. I think a tick for ensuring integrity of the system, right? So because you have got a blockchain type of system, you can ensure that it's fraud proof in many ways, right? And so it's a ledger system that I think the ledger technology is very useful. But then on the other hand, I'm not really sure how it integrates with the other. So I'm ambivalent. I have colleagues, Simon Erickson and Steve Simonton, who are very bullish on crypto. And then for the technology reasons and for all the other reasons and all the problems, like all the payment rails are different across different countries. If you have, crypto can basically leapfrog that. So I am just skeptical to some extent. I love the technology, but I don't know. So I'm gonna put it this way: I am very bullish on the applications of blockchain. I think blockchain as a technology can be used by pretty much any company that wants to develop a distributed, safe ledger, a provably accurate ledger system. I don't know what the future of various currencies is, whether it's Dogecoin or Ethereum or Bitcoin, right? But that's my take. I don't have any investments.
Yeah, I want to frame this way because a lot of people have actually made the theory saying that, okay, most of these cryptocurrencies were just created to pave the way for the central bank digital currencies. And we've seen a lot of central banks from the US to even developing countries saying, okay, we're going to bring up our own digital currency. Now, do you think the digital currency can actually solve some of the problems that are associated with the cryptocurrencies while actually just advancing the cost of reducing the devaluation of currencies as a whole?
Yeah, so I think this money printing is maybe a problem, may not be a problem. I don't know. I'm not an economist. I'm not really sure whether. So I think let's take what the digital currencies do, right? So take cash economy, for example. There's a huge cash economy in places like India.
Yeah.
Cash transactions mean that it's not seamless, it's not smooth, there's no tax collection happening on many of the cash transactions. If you go fully digital, everything is trackable, and therefore you can have better circulation of money, more seamless circulation of money. You can move the money around more quickly, you can get more tax revenue from it. There's a reason to do that, right? Also, you don't have to do things like this black money, like India did this demonetization where it pulled out money from circulation, right? That's really hard physical thing. If you had to, you wouldn't have to do that with the digital world. So digital world solves for many of these problems. You could still have more money being inserted into the system if it is digital, right? So you could do quantitative easing, which is another thing so I think if you went to digital, you'd still have the problems we have of payment rails today. Like the payment rails are still different in different countries. It become easier, but there are different rules, regulations, and exchange rates and things like that have to be taken into account, right? And different countries will adopt digital currencies at different points in time. So I think digital currencies will happen for sure. I'm like when I say for sure, I think the very high probability that that's going to happen in the next, say, 15 years or 10 years, or something like that.
Yeah. Okay, all right. Let's just, I want to get an idea of some of the stocks that you are interested in at the moment before we take any question the chat has to give us. What are the stocks? Because we know you are into tech, obviously. So what are the tech stocks that actually, like you are looking at the moment, you're thinking, okay, this, I may actually have to look it up a little bit more. Is there any one or two stocks you can actually give? You can look it up on our own too.
Yeah, so most of my stock recommendations that I make are on the 7investing service. So I just have to be careful to not divulge something that paying subscribers might not be happy about. But so I'll give you a couple of companies to look into. I think one company that's very interesting to look into is a company called Cloudflare. The code is NET. This is, some people call it a security company. What I call it's a networking company. It's a networking performance company that does a whole bunch of different things. But I think this is interesting largely for one reason right now, and which is what they're building at the edge of the network. So at the edge of the network, basically they have so telcos have what's called point of presence. It is where one telco talks to another telco on another network. At those points of presences, these guys have sort of, there are data centers, and these guys have their own rack of computers sitting there, and then they run their own platform on it. this has the potential of challenging the likes of, the Amazons in terms of the web services that they offer, right? So I think that's very interesting, and it changes the dynamic in terms of latencies and so on. So I think that's one very interesting company to think about. I'll give you a less interesting company to think about. Another interesting company to think about is Apple. It's the largest company on the US market, and people think, oh, it's, but what about Apple? What I think people forget about Apple is, I'll give you a different way to think about Apple. What makes Apple really special is their ability to combine computer-human interaction. That's what Apple is about, right? So the Apple makes very good human-computer interaction design decisions. And that is a powerful tool because that allows them to do all sorts of, so they are basically the leader when it comes to introducing new consumer tech things, right? So, there were wristwatches, digital wristwatches before Apple, but when Apple Watch came, it basically changed the industry and how, everybody basically copies Apple. And I think there's a lot more to happen in wearables. There's a lot more that can happen in, augmented reality and virtual reality. So I think the company to watch in terms of those trends is Apple. And it's an interesting company because, again, they have a huge cash flow. They buy back shares. So on a per share basis is basically, the share count is shrinking, your free cash flow is increasing. And then they have huge optionality in that. So that's another company to think about. What else can I tell you to look into? Yeah. I think another company that, again, an obvious one that people can, so here's something in a homework lesson, is to go and think so if you think self-driving is going to be a big deal, then, you hear about different companies having these things on the road, right? But what makes Tesla self-driving really different from other people? And I'll tell you why I think it's different. One of the things, you can call it, this is an ethical, maybe this is an ethical debate, but one of the big advantages Tesla has is Tesla basically has a fleet of vehicles on the road that has a semi-autonomous system on it, which is doing these semi-autonomous decisions today, which it can then use to train when it makes a mistake, for example, and the driver has to take control. And therefore, their approach allows them to continually refine their strategy of building better and better models for self-driving, right? And I see no other company has this option because nobody else has done it this way. And so there's, you can say that, regulators can at some kind of time say, but, it's basically, you're saying that I'm giving you a driver assistance system, which is actually a self-driving system. And then, you continually refine, right? So my car, basically, when I drive my Tesla, from the highway entry point to highway exit point, 99% of the time, it can do everything. It can get into the highway, it can change lanes, it can get out of the highway. It still makes mistakes those 1% of the time, but 99% of the time, it drives flawlessly. So every person using this car can, either when they're using it, are providing training, or when the car is not, you're just driving it, it can run the algorithm in shadow mode and it can compare that with how you are driving and make these decisions, right? And collect data. That's a huge, huge advantage that I don't think anybody else has. So again, that's something to think about and its implications.
Okay, I don't want to dive into the Tesla, but let me just ask one quick question. Something they mentioned during their AI day. They mentioned something about purchasing a supercomputer that's going to make use of all the data they've collected. And that seems weird to a lot of people because a lot of people thought this data they've been collecting already, because we know they've been collecting data from the FSD, the cars on the road. So what have they been doing with it if they are just like purchasing the computer for the processing? So I don't know whether that's a very positive one for them.
Yeah, so what they were talking about is they are not purchasing the computer, they're building a compute facility. They're building their own hardware chips, which they're calling the Dojo computer. So when they build it, that'll be one of the largest supercomputers in the world. Or they actually have something running, but so I think that here's a problem. The problem that they're trying to solve is you collect a lot of data, you have to label it. So basically machine learning works as follows. You collect data, you have to label it. You have to say what the data is. That then you feed into a model, the model is built, And then the model looks at new data and makes decisions. And some of them are going to be right and some of them are going to be wrong. And then again, you're going to look at those wrong decisions and the right decisions and figure out how to retrain the model. So it's a loop. You get data, you label, you train the model does something, you get more data, you loop, and you continue looping, right? And you refine your model at every step. The challenge they have, what they are saying is they're trying to label in what they call the vector space, which is basically, or in 3D space, which basically they're not labeling images anymore, they're labeling video. So they've got images and a sequence of images over time, because that's what video is, and they're trying to label that. There is no infrastructure currently available for doing that. So they're building the entire infrastructure for doing this on their own. So they have got an entire labeling infrastructure, right? The other thing that was very interesting, what they showed us is when a car is making a decision, it is actually running a simulation. Yeah. In your car, it's running a simulation. It's saying, okay, they're making 2,000 decisions. Okay, this can happen, that can happen. That car that's on the road can do this, and therefore I should do this, right? So they're building this data, they're labeling it, then they're doing simulations in the car, but they're also doing simulated things, right? So to run all this infrastructure, they're building the AI infrastructure for doing this. Now, you could say, why can't you do it with the existing tools? Well, existing tools can't do this. Yeah. That's number one. Number two is that the scale that this needs to be done is huge, and therefore they need to build the infrastructure for doing this. But then the number three thing is that this is probably the biggest real world AI challenge that exists. If you can solve this, you can solve many other AI problems, which means the infrastructure and tools that they're building can be very useful for other problems. So, there's potential for making this service available at a global scale for other problems in due course, right? Once you build the infrastructure. So I think, again, this is a very high risk type of bet because their strategy is really only based on vision. Computer vision, and just as 8 cameras on the car, then no longer using radar. So again, you make what you will of it, but it's an interesting strategy.
Okay, I just have to ask you this. Do you think there's any reason why, we know that Elon Musk is not a big fan of Lidar, like light detection systems, and he actually, I've seen him several videos speaking against it. Do you think there's any special reason for that? I know he's a big fan of the visual concept, but he's just against the light detection systems. Do you think there's any reason why he's really against light detection systems?
So I don't know. So he has said this couple. So here's the thing. I don't think he's against the technology per se. So his rocket company, SpaceX, uses LiDAR. Right, yeah. So they use LiDAR there. It's not that he doesn't know what LiDAR does. I think the problem with LiDAR is that he calls it a crutch. And his point is that what you're solving with LiDAR allows you to solve for a short-term problem, but doesn't allow you to solve for a long-term problem. So LiDAR can do certain things that maybe makes it appear that you're solving the problem right now. But ultimately, you don't want to use it, right? And then the other thing I think against LiDAR is very expensive. And it's also a very big piece of tool that you have to put. So, LiDAR is basically light emitting rays that you're throwing out, and then you're getting in the cell. So it's only near-term vision. His other argument, which is a straw man, is very interesting, I think. His straw man argument is humans drive with 2 eyes. So in other words, you've got 2 cameras, and that's it. Right? If I've got 8 cameras and I can't drive, then the safest thing at that point for your car to do is to stop. Right? Which is what we do, right? If there's a huge snow or heavy rain, then the safest thing for us to do is just park on the side of the road and wait for the weather to go away. Right? So maybe LiDAR helps you drive in that situation, but maybe the human-like behavior is to actually stop driving at that time and just wait. So again, I don't know. I think the problem with LiDAR right now is because it's so expensive, you can't have a commercial system that uses LiDAR. And then if LiDAR becomes cheap over time, there's no reason that they might not use LiDAR, right? But I think in the meantime, they're trying to solve maybe 99.9% or 99.5% of the problem using vision. And if they can solve using vision, then maybe they can introduce Lidar at a later point. The other thing I'll add is there is academic work out there that basically says that if you have got enough cameras in a car, you can simulate what Lidar does today, right? So you can get similar behavior. If you can get similar behavior, then it basically means that Lidar is not necessary. So again, I think the problem is very challenging. What most people are doing is using Lidar, and they have geo-mapped areas that they are introducing vehicles in. So that's different from trying to drive in an unmapped area.
Wow. All right. Thank you. We've actually gone deep into this. And I really enjoyed the perspective you brought from the AI, because a lot of things I do understand a little bit. A lot of people don't understand the perspectives of these things. So some people are just like, Elon Musk is against Lidar and they don't understand this. Okay, let me just ask you the question we have in the audience. Then maybe we can just give us some closing notes. The person in the audience said, which one is better for a beginner? Blue chip stocks, growth stocks, or ETFs? Which one would you recommend for somebody that just wants to start today? From the mistakes you made and all that, what do you recommend for somebody who started today?
So my answer would be, it depends on your age and your mental framework, right? So if you're young and you've got a long window to invest, then you probably want to invest in growth stocks, because that's how you're going to get the best returns, right? And compounding basically takes time. But investing in individual stocks means a little bit more work. It means either you buy somebody's research that you trust, or you do the research on your own. And actually what I would say is that you can buy the other people's research, and that's important. It gives you an idea and it gives you a starting point, but you'd still have to spend some time on your own to be convinced, because ultimately you are making those decisions, right? Okay. So if you do not, you cannot buy conviction, right? You can get ideas, you can get a great list of ideas, and you can get most of the research done for you, but you can't buy the conviction still. You have to be convinced yourself, whether it's by reading it or by doing some research. So never look at an idea as a ticker. Look at the research associated with it. If you don't have time that you can give, then maybe ETFs are fine for you, right? I mean, I would say invest anyways, because investing over the long term will give you good returns, or it has historically given good returns. So you just invest in some broad market indices, and that's a good starting point. But if somebody's interested and is a student of the market, and then they should look at individual stocks, and then type of. And it's not necessarily. Here's the thing: you can get great returns from blue chip companies, right? Like an Apple over the last 5 years has delivered fantastic returns. That's a blue chip company, right? Amazon over the last 5 years has delivered fantastic. That's a blue chip company. So a blue chip can be great as well. It just all depends. I think you have to find what works for you. I think that often people get stuck on that question, and they think, I need to find. Process evolves over time. So make your process evolve it over time, right? And don't be too fixated, I think, right? And one of the advantages for the early, if you're starting early, I guess here's my main advice. If you're starting early and you have a lot of money that you invest, don't invest everything at one go. Because you're going to make some mistakes. If you're starting now and you are young and you have a little bit of money only, that's great, because you're going to make mistakes with small amounts of money, and over time you'll learn. And by the time you become older and you have more money to invest, you're actually making the right decisions, and you've found your style and you've found your approach, and things are fine, right? So I think that's the way I think about it, is that it's better to start early and start small and find your way.
Yeah. Wow. That's fantastic. I don't want to keep you much longer. I'm just hoping that sometime again we can actually have a chance to interact, because this took a lot of time and a lot of effort. And I'm hoping one day maybe you can even come to Nigeria as well, and then maybe check things out for yourself, and maybe get some past memories and all that, and enjoy a little bit of the African continent. So I really want to thank you. But before we let you go, you just have to give us some closing words. What do you think, like final advice for the people listening? What do you think the retail investors should just have in mind always?
Yeah, so I'll say a couple of things. One is, investing is a lifelong pursuit. It takes a long time to develop. As an investor, you're always developing, but it takes a long time to just get the hang of it. But I think it's worthwhile, because it allows you, one of the things I think that's great about investing is it allows you to see the world in a different way. right? Because companies, there are thousands of companies in the world, and companies ultimately serve people. This is a way of understanding how the world is being serviced by, different people. Companies are ultimately made by people, right? So it's a great way of understanding what's happening in the world. I love that. And that's one of the reasons to study business, is to understand the world. So that's one thing. Number two is, I have this thing that I say, if you want to invest like the best, you want to invest the best. So I only think, only invest the best ideas. Do not invest, investing in second tier ideas is not really useful. Third tier ideas is not really, and what is best, top tier ideas is going to vary from person to person, but you want to invest in your top tier ideas, right? If you know deep down in your heart that you're investing in second tier ideas, then you should invest in those ideas, right? Many people forcibly, they sort of tend to invest in tier 2, tier 3 ideas, and then they make it seem like this is the best ideas, but they're not. They themselves deep down know. Don't do that, because that just hurts your returns. Except that there's going to be volatility. There's going to be volatility all the time. And you need to be able to play out. You need to live through the volatility and be okay, right? So another thing I say is that, you want to only invest that money that you don't need for at least 5 years, right? That's the amount, that's the money that goes in the market. Otherwise, you shouldn't put that money in the market, because you're going to be in a tough spot. Look for innovators, and innovators are, again, they make it more interesting for you, that you learn something out of it, and then innovators are the one that change the world. And if something changes the world, usually that's good for your pocket. So that's something to think about, right? Look around you. I think looking around you, and in news and things like, so people are lining up for something. If people are lining up to buy Tesla Model 3s, and without even seeing one being made, that is a good sign. If people are lining up to buy the iPhone, that is a good sign, right? How many times people line up to buy stuff that they haven't seen? Very few number of times, right? Those are companies that are special in some ways. So if it's special, pay attention. Look around you. Emerging markets, pay attention. If you're in an emerging market, pay attention to what's going around you, what's happening. There might be things specific to Nigeria that are then applicable, you see, to other places, Kenya, South Africa, and so on, right? And it's a large continent. So I think, you have an advantage of being in a economy that is hyper fast growing, has a large young demographic, and it's really the growth engine. Many companies want to actually grow in these markets, because this is, in many ways, Africa is the last frontier, right?
Yeah.
For growth. Next up would be Mars after that. This is the, a very historic continent, a continent which has a large history, long history, that lots of opportunities exist. So I think, thinking about that is useful. So those are some things I'd say, think about it, use your situation and your opportunities to your advantage.
Yeah. Wow. I'm so grateful for the time you actually brought that to speak with us. I'm so grateful. I want to thank you so much. I'm going to link your profile and every article you've read in the groups and in the description of the video, so that anybody can actually just find a way to contact you after this. I want to thank you so much. I'm hoping we can speak again soon. Yeah. Do have a wonderful day.
Yeah, you too. Take care. Thank you.
All right.
Bye.